Markets, why do markets go up and why do they decline? To understand this, you have to understand how the floor works, what the psychology of the traders are, who's in trouble, and what will cause the market to react the other way. On the floor, there's a bid and ask. The buyers bid, the sellers offer or ask. Hands out, selling, hands in is buying. They always say at when they're selling. If the bid is, to take just a rough number, is half or 0.50, it'll be 50 bid or half bid. If another trader in the pit wants to buy more, he has to take it up because he can't bid it lower. He can only bid it higher. So if it's half bid and the sellers aren't coming in, he takes it to 60. And how does he do that? He yells out 60 bid. Now all the half bids are no good anymore, and they have to become quiet because someone has taken it up to 60. Now what happens if somebody else wants it even more? He'll take it to 70. So this is why you get these moves in the market, half, 60, 70, 80, 90, even bid. It'll go up because the buyers want to get in, they want to buy, and the only way they can do it is to bid it higher. They're not allowed to bid it lower in the immediate time frame. So if it's half bid now, somebody else can't yell out 40 bid that second because it's half bid. It works the opposite way in selling. At even, at 90, at 80, at 70, at 60. This means the sellers want to sell, and to do that they will take it under the prevailing offer or lower. This is why during the day you have all these mini panics, because when they run the stops, guess what happens? Let's say the high of the day is even, and you've got to stop to buy it at the higher 10 or the higher 20. Somebody takes it to even, then somebody bids 10 for it, and the broker with the stops, or brokers rather, all start bidding because the stops become market orders at that point. So what's going to happen when it gets there? The market's going to run because you told your broker when it gets to 10, I want out, I want to buy it. And what happens? 10 bid, 20 bid, 30 bid, 40 bid, anything to get that seller to come in and agree with the buyer on that price. And this is why you get these mini panics, and it's also the reason why you often want to be taking the other side at that point. When the panic comes in buying, you want to be selling into it. Because what will often happen is the market then will retreat and go the other way. So that's how the prices move up. Now what happens when you have a rally? Prices are bid up, and sooner or later they're going to come down. Why? Because the people who bought it lower have to become sellers to get out. And everyone wants to maximize their profit, so what happens when sellers come in and all of a sudden the buying ceases? The sellers have to offer it down to draw out buyers. Now you multiply this by thousands of people trading at the same time, and you get the rundown. So you get what I call an equilibrium point will eventually be established as the market starts to come down. So you get the rally, you get the counter trend down, and then you get the second leg with the rally up. And that's where sniper trading wants to come in and start buying typically. Now a question that comes up all the time is, why don't I get the first leg and not just the second? Well, fine, I try to do it myself, but it's not easy to do because you don't know which way it's going at that point. The first leg tells you the direction. It gives you other important information too. It tells you how long it took to form that first leg. And then you've got the pullback, the equilibrium area, what I call the consolidation. And it's in that area where prices should stabilize prior to the second leg. I'm getting a little ahead of myself, but even still, the equilibrium point is 2 consecutive closes at the same price on 2 bars. So it can be 2 one-minute bars, it can be 2 5-minute bars, whatever you're watching. Though I tend to look on the 1-minute bars for this. So let's say it's more the market opens, it trades for a while. Often there's a counter trend. If it's going up, it'll go down first, and then a rally will come in. That first rally will be the pure move from a low to a high over so many minutes. It will sell off. It will start to go sideways. It'll get choppy. It'll pull back as the buyers take profits and new buying comes in. And sooner or later, you'll have that equilibrium point where the market now has stabilized. Now, in there is where you start thinking about a point to get in. We're going to get into that in a minute, where specifically you get in. But you set up a zone, and that's where you go in to buy it. The beauty of this type of trading is, if it doesn't work out, you get out immediately, because it should do certain things prior to that second leg. Moreover, the second leg should go to a certain price based on what it did the first time. In addition to that, it should go to that second price within a given time frame. So you've got these parameters to look for, and you'll see as we go along here, in looking at the workbook, that very often you get it right to the minute and right to the tick. Not always, but certainly very often. Here we have a leg in an equilibrium. It's hard to see on page 17, but and this is on a 1 minute bar. So you have a rally up, you have an equilibrium, and then you have the second rally up, and by then you've already targeted where it should go. In this particular illustration on 17, it got there, but not on really the second leg. There was a pullback, and it got there later on. So it did fail in terms of the second, in terms of time and price specifically, but it ultimately did get there. The point I'm trying to make here is that there is a leg, there is an equilibrium, and there is a second leg. Now, the other side of the coin to price is time. And I think that everyone looking for these moves has to pay attention to time. There's a symmetry in the market that you will see over and over again. And when I talk to people, I stress, don't take my word on this. Look at it yourself and convince yourself that that symmetry is there. Because then you'll be able to go in the market, you'll be able to take trades, you'll have confidence in what you're doing, and you won't just be guessing. I've made all the mistakes over the years that everybody watching this video has made. And believe me, I know what it's like to get into a losing streak and have everything just go wrong. I've also been able to put together some good winning streaks, and I know how satisfying that can be, because you out-traded a lot of sophisticated people, including floor traders who do this for a living day in and day out. And remember, they're playing a different game than you're playing, very often at least. The scalpers are just trying to get the edge on you. They're trying to buy it at the bid. They're trying to sell it at the offer. Now, you can't do that off the floor. You can try. Occasionally, you'll be able to buy the bid, and occasionally, you'll be able to sell the offer. But most of the time, you won. And that's why I try not to use limit orders. I tend just to use market orders. The beauty of market orders is that you know right away whether you're filled or not. And that's what I need to know doing this type of trading. And I also want to stress that you have to leave your ego outside the door when you do this type of trading, or any type of trading for that matter. You're going to be wrong a certain percentage of the time, and you shouldn't take it personally. It's just something that happens when you trade. I was talking to someone about a week ago, and in the phone conversation, the notion of losses came up, and he said to me, you mean you still have losing days? And I said, of course I do. All traders have losing days. The ones who don't have losing days aren't telling you the truth. So losses are just a part of trading. It's a process. If you do the right thing enough, you'll come out ahead. If you do the wrong things over and over, you'll lose. And ironically, you can often win the most when you do the wrong things, and that's because you're not really aware of the risk. This is why new traders often have winning streaks, because they're not really aware of how risky it is, and they take chances and it works out. But if they do that enough, they're going to end up on the losing end of things. Not long ago, I was trading with a client of mine in Florida, and he was short, and the market screamed up against him, and he didn't get out. So I'm watching him and I'm thinking, well, what's he going to do? And the market is really screaming against him, and I would have been out a long time ago in this move. And he didn't get out, and what happened was it came back for him. It came back to like break even. He gets out and he turns to me and says, see, I knew that would happen. And I said, if you keep doing that, you're not going to be able to be a trader because you're going to lose your money, because very often it doesn't come back. And there have been many illustrations recently in this market where it goes higher and never comes back. So remember that losses are just a part of trading.